All right, well, let's address the tax situation. First of all, I'm not a tax advisor. Always consult a tax advisor, and the example given is very simplistic in an attempt to teach you the true value of the home ownership tax deduction. Folks, this can be one of the most exaggerated aspects of buying a home. Now, don't get me wrong, tax deductibility is a great benefit of buying a home, but many mortgage and real estate providers way overstate how much this will actually help the buyer. Let's see if we can shed a little light here on the subject. First of all, the threshold for tax deductions are $5,350 for a single taxpayer or $10,700 for a married couple filing jointly in 2007. If you don't have more in write-offs than these two amounts, then it doesn't matter if you own a home or not. There's no tax benefit of owning. For example, let's say a married couple buys a $130,000 home on January 1st with an FHA loan amount of $128,981 and an interest rate of 6.5%. That's not the APR, that's just the note rate. Their principal and interest payments are $815.25. Their homeowner's insurance monthly is $55. Their taxes are $145 a month. Their monthly mortgage insurance premium is $52.95, so their total payment is $1,068.20. They paid in that year, they would have paid $8,341.32 in interest, $635.40 in mortgage insurance. And folks, in 2007, for somebody that makes less than $100,000, a married couple that makes less than $100,000, they can deduct that mortgage insurance. Now, will it be continued on after that? We don't know, but in 2007, you can. There's $1,740 in property taxes. Now, let's also assume that they're living in Missouri and they paid $600 in personal property taxes and they donated $1,500 to their church or their favorite charities. So all of these items are tax deductible. So their total tax deductions are $12,816.78, which is $2,116.72 more than the standard deduction, so it makes sense for them to itemize their taxes. Now, we're going to assume that in 2007, these folks made more than $63,700 and less than $128,500, so they're in the 25% marginal tax bracket. Let's assume a 6% rate for the state, so their combined marginal tax bracket is 31%. Now, it's not their effective rate, the rate that your accountant will tell you. This is the marginal tax bracket. This is where your savings reside. Since we exceeded the standard deduction by $2,116.72 and we itemized on our taxes, we can reduce the amount we owe Uncle Sam by 31% of that $2,116.72 or $656.18. If we break down that monthly, it's $54.68 a month. So you're actually saving in taxes by owning a home in this situation. Now, it's not the $3,973.18 that most real estate and mortgage people will tell you, which is 31% of the total of your write-offs of the $12,816.72. That's what the uneducated mortgage or real estate provider tells you, and it's not correct. What I just gave you is pretty accurate, but always consult your tax advisor. There's a benefit, and it can be a very significant savings depending on your situation. If you own a more expensive home, your write-offs are more. Now, technically, you could adjust your withholdings on your paycheck by the $54.68 in our example and bring that much more home each month, and basically you'd pay the same taxes you did last year, assuming everything was equal. And like I said, get help from a professional tax advisor before doing this. One of the biggest fears homebuyers have is about their credit and is it good enough to be able to buy a house. So let's go ahead and address that a little bit right now. Credit scores can range from 350 to 850, and when you get into the sub 600 range, then things get really much more difficult to qualify for a house. Not impossible, but much more difficult and usually more expensive. If you fear that you've got credit issues, then get with us as soon as possible so we can help you to assess what needs to be done to maximize your credit score. Many times we can help you do a few things to clear up inaccuracies on your bureau that could raise your score up to 100 points in a 30 to 60 day period. I remember an old 60 Minutes episode that said that as many as 75% of credit bureaus have errors on them that could keep someone from qualifying for the best possible interest rate. So that's something that's real important to try to do. Your credit score is impacted as follows. The 35% of the score is based on your payment history. Another 30% of the score is based on how much your balances are allocated on each credit account. Now that means if you've got a $5,000 credit limit and you've got $4,800 on a credit card, and you've got another $5,000 credit card with nothing on it, your score is going to be lower having it structured like that than if you had 2,400 on the one credit card and 2,400 on the other card. So anytime you start getting over a 30 or a 50% of amount of your allowable credit on a particular account, that starts to ding your score. There's a 15% that's based on your credit history, and 10% is in the mix of accounts that you have. If you have a bunch of like beneficial finance or ITT finance, those type of accounts, that will hurt you. And especially if you don't have car loans or a house, when you have a house, that actually helps strengthen your credit score. And then the last 10% is on the number of times you've tried to apply for credit in the past 90 days to 12 months. They feel that if you're trying to apply for a lot of credit, if you've got a lot of inquiries, then there must be something wrong. Either you need a bunch of credit or you're getting turned down. So that's something that they will focus on. Now, let me suggest that even if you're just thinking about buying a home, get in to see us or another credit expert or a certified mortgage planning specialist so you can have your credit evaluated. The only cost for us to do that is the cost of the credit bureau, which depending on how we do it, it's less than $20. I can't emphasize the importance of this enough. And like I said earlier, we have a system that we follow that's raised credit scores as much as 100 points in as little as 30 to 45 to 60 days. The best thing you can do to save the most money is to make sure you have your credit score optimized. So give yourself enough time to do that. Give us a call at the number on the cover of the video, and we'll definitely be happy to help you with that. Let's talk about assets, how much assets are needed, and some of the myths here. Most people think you need a whole bunch of assets to buy a house. You don't need a ton of money in investment accounts, but most programs you do need to have some, even if we don't use it at all. I mean, we may not use it all. We may not use any of it. But lenders do like to see money in what they call reserves, which means basically if you lost your job the day after you signed your loan documents, how long could you make your payments? That money could be in IRAs or 401ks, and we're not going to tap them. They're just there if needed in the case of a financial emergency. Now, on a side note, many people will think about borrowing from their 401k to buy a home. Now, folks, this is not a good strategy. Now, the reasons are pretty complex. If you'd like to know why, if you're thinking about doing that, give us a call at the number on the video case, and we'll be happy to explain that to you. Now, where these funds are, the